the last 3 years, New Zealand's rates bill on average has gone up 34%, I think it is. And in Wellington, the average rates bill in the last 3 years has gone up by 47%. Nearly a 50% increase over the last 3 years.
I mean, that is massive.
That is insane.
Truly huge. Welcome to the Lowe Down. I'm here with my mate Adam, and we're going to talk today about the exorbitant rising insurance costs, the crazy rate increases that we've all been feeling over the last few years, climate risk, and all sorts of. We're really going to go political stuff, perhaps. We're even perhaps going to go there.
This is
all
dangerous
sorts of
ground,
topics.
Craig. Dangerous ground.
I agree.
Yeah. And
And
are we experts at this?
No,
we're not.
no. So this will be a lot of opinion, of course, but one thing is
a lot of questions, really. Eh?
A lot of questions.
Be a lot of questions. Yeah.
But it is fact that we've been dealing with rising costs, significant rising costs that are way ahead of inflation. Like we're talking like miles ahead of inflation.
Yep.
In particularly rates and insurance.
Yep.
I mean, when someone pays their rates, Adam, like what are they paying for? How do rates work?
Yeah. So, like I said, look, I'm not an expert on this, but rates is basically the property owners funding the local council running the city. So all of the city infrastructure that the council pay for. So that's your roads, a lot of it is your underground infrastructure, all the pipes, which of course in Wellington we've been talking about for ages because they're getting old and falling apart. Delivery of water, so water pipes, stormwater systems, stormwater meaning the water that comes off your roof, down the gutters, down the drain pipes and so on, and then into the curb and channel or into the council stormwater system, and that takes it away. Sewerage, of course, as well, removing all that good stuff from your households, and it all ends up in Moa Point to be treated. And so treating that so then it can be disposed of way out into the ocean so it doesn't kill the beaches around the place. What else does the council do? Roads? Schools? I don't know. Is the council responsible for schools? No, that's government, right? But roads, I think, have a big impact, input into roads. So all of that infrastructure, local street lighting, I guess.
And all sorts of products. I mean, the ones that are most visible to people, of course, are things like, the big projects they end up taking on because they get a lot of exposure, a lot of media exposure, like, the hole in the ground that is the old Town Hall, which they're making into the National Music Centre, right?
Yeah. That's right. So you've got local
infrastructure
civic
projects.
Assets, like the Town Hall, like the library. I mean, that's been closed for years and years and years now. There's all that stuff as well. So library, Town Hall, all that sort of thing. So the rates literally is a tax on property owners to fund the running of the city's infrastructure, right? The services and assets that the private market wouldn't supply, I suppose, right?
Yeah, and there's a perception out there that your rates, that your rating valuation, which is gives you a capital value for your house, is how the council sets its rates, which is that's true. But there's a perception that rising capital values means rising rates, which of course you would expect then if your capital value went down, they all have by an enormous amount in the last round of rating values. Why are people's rates not going down in that scenario? Yes,
because there is a relationship between your rating valuation and your rates bill. But it's not just simply if your rating valuation goes up, your bill goes up, or if it goes down, your bill goes down. The council set a budget for running the city over the year, and that budget is however many hundreds of millions or billions of dollars, I suppose it must be. And then they apportion that budget across all the property owners according to their rateable value. So if everyone's rateable value stays the same, as it does in between RV adjustments, because RVs only get adjusted every 3 years.
Yes.
So we've just had the new rates being struck from the 1st of July because the rating year goes from 1st of July to the 30th of June. So 1st of July 2025, the rates are now set until the end of June 2026. When the 1st of July 2026 rolls around, our RVs haven't changed. But the council has set a new budget, and that budget might have gone up by too much the way things are going. If it went up by 10%, then on average, everyone's rates bill will go up
regardless
by
of
about 10%.
what their rateable value is, right?
Yeah, that's right. Well, because everyone's rateable values have stayed the same, then the percentage increase, everyone wears about the same percentage increase.
Yes. So it's and my understanding is the only time your rating valuation really makes a difference to the rates that you pay in a relative sense, that if your rating valuation goes up more than your neighbours does, because you did a whole lot of improvements that went through the council through the consenting process, and your rates go up relative to everything else, then you will pay more because your rating valuation has gone up.
Yes,
and that's
correct.
How they'll assess it.
So, and the reverse is also true. So if like we've just seen, rating valuations come down a lot, if everyone's falls in half, drops by half, and the council budget remains the same, then everyone's rates will
be identical,
be the same.
Yeah, same as what they were before. Sorry.
Okay, but what we've had recently, of course, is a combination of councils' budgets going up enormously. So what's the data? The last 3 years, New Zealand's rates bill on average has gone up 34%, I think it is. And in Wellington, the average rates bill in the last 3 years has gone up by 47%. Nearly a 50% increase over the last 3 years.
I mean, that is massive.
That is insane.
Truly huge. Yeah.
No wonder the householders and the rates payers are absolutely screaming. But what we've had recently, of course, is we've had budgets going up, the council budget going up, and rateable values coming down. So overall, because the budget's gone up, everyone on average is paying more because there's more money to pay. Simple as that. It's just then the balance of one person's rates bill and how it changes versus another person's will depend on the degree to which their rateable value has changed compared to the average.
Relative. Yeah,
right?
Exactly.
So some suburbs, in particular northern suburbs with the lifestyle blocks, Makara, Ohariu, Takapu Valley, these places, those rateable values, they haven't really dropped, not by much. I don't have the actual data, but Wellington city, central city suburbs, the more urban areas, they have dropped further. And so the rates bills for those poor folks with the lifestyle blocks, they're paying the price for the fact that the value of their properties has not dropped by very much at all. I mean, that's a bit of a COVID hangover, isn't it, with the lifestyle, people still chasing the lifestyle. The central city is still out of vogue, really, isn't it? So it
doesn't make me feel any better about my rates increases over the last 3 years being in the central city, but it's nice to know that.
But what this means is that your rates bill has gone up by a lot less than someone who has the equivalent value property in Takapu Valley or Makara or Ohariu, Anyway, so does that answer the question?
Yeah, I think it does. It really does. Yeah. And of course, people are seeing this, but you mentioned the council budget. Of course, and it's very topical and it's very political.
Yeah.
But the reality is that what the council spends their money on and what projects they choose to do, it makes an enormous difference to every single what everyone's paying. And there are a lot of retired people who really can't. I mean, you think a 47% increase in rates over the last 3 years.
Yeah.
That's going to disproportionately affect people who can't afford it, older people, retired people.
As with all inflation, well, I'm just trying to think of, there are always exceptions to the rule, I guess, but generally speaking, vast majority of the time, inflation impacts the poor far more than it does the wealthy.
Yeah. And so we look at that, right? Then it does make you a bit frustrated, doesn't it, when you look at things like the National Music Centre. Now, look, I'm all for having an amazing National Music Centre. I'm also all for retaining character, right? Like both of those things are noble. No doubt about it.
But not at any price.
Not at any price. And there's the sunk cost fallacy, right? When you start digging a hole, there's a view, I think when we got to like 180 million but way before that, when we're staring down that barrel and knowing the risks, at some point, wouldn't it be way more rational to go, okay, we've blown 100 mil here, or we've blown 80 mil or whatever, but it's very uncertain whether we're going to get it done with, within reasonable budget. So let's just cut our losses, demo the building, right? Get the required resource consent, whatever, to demo the character building. Going to lose that, and we'll just build a brand new, beautiful National Music Centre for significantly cheaper than trying to retain what's there. Now, I don't know all the ins and outs and the details. This is just my take on it.
And I'm not an expert either, but I understand that their costs are approaching 400 million.
Yeah, well, that's exactly.
Well, that's $1,000 for every single person in the Wellington region.
Yeah.
Child, retired, working, everyone.
It's unbelievable amount of money.
$1,000 for every single person.
Yeah.
Now, I'm sure that if you went up to someone and said, I got a great deal for you, you only have to give me $1,000 for everyone in your household, and you will get this infrastructure or this asset for the city to be able to enjoy, for the rest of your life. No one's going to take you up on that offer.
No way. So that was a bad move, and I think the council fell into the sunk cost fallacy, which is where once you've sunk a whole lot of money into something or invested a whole lot of time and energy, you feel committed, and you feel committed to. And the problem is, two mistakes don't make a right. If you've made a mistake with the first half, you don't go and make another mistake for the second half, do you? At some point, you just got to go, nah, enough's enough.
Yeah.
There's a different approach.
So Craig, obviously local body elections coming up soon. In terms of Wellington's local body elections, what does that have anything to do with this, or what do you think about that, and what's going to happen?
Well, people will vote with their feet, won't they?
Yeah,
I mean, the reality is that people this is the chance for people to have a say into the future.
I think that's the important thing, isn't it?
Yeah. And look, politics is not my it's not my specialty. I really don't know a lot about politics, but I think it makes sense for people to really try and be rational about it. Try and look at the different candidates and the different parties and how they are approaching the budget and the future and what they're talking about. And we need to get away from vanity projects. I think right now is not.
We should be just doing nothing but absolute core business.
Yes, absolutely.
Nothing else.
And it's return on investment, isn't it? We need to know that
Do you think the people who are controlling these? This is an enormous amount of money and a huge amount of responsibility that impacts all of us, right? Do you think the people in the council who are running these things actually understand return on capital and capital deployment?
I imagine, just to
surely
give
they
people
do.
credit. I don't know the people in the council.
Surely they do.
But I think you've got to give people, I mentioned it's tough, right? It's difficult. This is,
it's complicated.
And this is often decision making by committees. A lot of people, a lot of incentives involved, and I mean it's really, really hard to make these big decisions. And people are trying to do the right thing. I think people's hearts are generally in the right place.
Nobody goes and joins and becomes a councillor or joins the city council for anything other than good reasons, surely. But I mean, it just doesn't seem like there's really a rigorous process of casting a ruler over everything and going, are we actually getting good value for money here? Are we getting a good return on our invested capital here? And that's really what needs to happen, isn't it?
Absolutely.
I don't know.
Absolutely.
But it's easy to sit here and throw stones, I suppose, isn't it? But
and the maintenance, you look at
totally.
So my understanding of the rates, and you'll not be to Adam, but there's a levy it's not related to the pipes, I don't think directly, but it's related to it's like the sludge levy.
The sludge levy that's just come in recently.
1.6% of your rates.
I think it's 1.6% of the average rates bill. And now that's a big chunk. That's 1.6. It sort of sounds like a small number, but the 1.6% of the entire running cost of the whole city, right? But I understand that's principally it's for the Moa Point treatment plant, and it's basically to better manage the disposal of the the leftovers after the sewerage has been cleaned up. All of the clean water gets sent out to sea, or relatively clean, and what's left behind is more solid sludge, and that's basically dealing with how to get rid of that in a way that is. I understand there's some compliance around it now, so there are rules that have to be adhered to. So that they have to implement some new infrastructure and a sludge treatment plant of some kind. But anyway, that's what that's about. I think it's come in the last year or so only. Yeah.
So rates are one thing, right? But what about insurance? I mean, that's because it's a double whammy at the moment, isn't it? And I think I read that insurance costs in Wellington are double that in Auckland.
About double what they are in Auckland.
I mean, that'll be horrible here. People won't. I didn't like.
Well, it won't be a surprise.
No.
To many people. I don't
Not nice
think.
to hear, though, is it?
No. It's a lot. And insurance premiums, they just seem to have gone up and up and up. I mean, I recall insurance premiums 10 years ago. I don't have the actual numbers, but it was like $500, hundreds of dollars a year to insure your house, right? And now 10,000 is not uncommon at all.
I think the average across the whole of Wellington is 4.5.
I mean, that sounds cheap to me.
Yeah, because a lot of them are, a lot of.
I mean, I'm fortunate enough to have a few properties, and I don't think any of mine are that low. So, I mean, in Kapiti, yes, Kapiti, a few $1,000s for your average little house or whatever. But in Wellington, in my mind at least, I sort of think insurance for a typical house in Wellington, freestanding house somewhere or other, 8,000.
I think we're
7,000.
I think we're of course operating in the central city, and so that number will be across the whole region. And,
yes.
And so, obviously when you average it across the region, it's going to be a lot cheaper.
But anyway, if it's double what it is in Auckland, that's horribly bad news for Wellingtonians. But I mean, why? Why is it so high in Wellington, do you think? And why has it gone up by so much? But I mean, that's like a factor of 8 or 10 times in the last 10 years.
We to some degree have to blame our geography. We are exposed clearly to earthquakes. We're exposed to,
but we always were.
Sea level rises. We've got, we're
a
stormy, windy city.
Has that changed?
No, but I think the problem is that the reinsurers have just worn significant amount of cost from natural disasters in New Zealand over the last decade. And of course, now they are looking to increase their premiums to, equate for the risk and to recover that. Effectively to
rebuild
recover
the
it,
balance
isn't it?
sheet, right? Okay, so that explains why insurance premiums across the country have gone up. But why is Wellington so much higher than Auckland or other places?
Well, it's perceived to be higher risk. And you know more about this than me. You trained to be an actuary, so you would understand it deeply more than I do. But my understanding is that when you reassess the risk based on the fact that we're sitting on a fault line and we have these exposure. I mean, we're coastal. We got sea level rise issues. We got also and as the climate is changing, like these risks are getting factored in more perhaps into the and that's just a guess from me.
I mean, yes, I've had some experience in insurance. My area was more life insurance and so on. But I think there's two things happening. One is that the data that the insurers use is way more detailed and location specific and risk specific. And so they call it risk-based pricing. And so whereas previously, like 10, 20 years ago, they might have looked at the risk in New Zealand, and it doesn't matter whether you were in Auckland, Wellington, Blenheim, Bluff, wherever, and it didn't matter if you were on the hill, on the coastline, on the edge of a lake, or on a cliff. The risk was spread out across the whole country. But now the data is way more granular, and so you can dig right into way more detail. And the idea is that the houses that are really risky, like the ones on the edge of a cliff, which is being eroded, or the ones that are right on the waterfront that are subject to potential sea level rising, or the ones that are on the floodplains where the flood comes through, if there's a huge, all that stuff. Why should the people who are living in relatively safe places, where the risk of loss of their property is actually very low, why should they help pay the costs of repairing the houses that are in the really deeply risky places? And so that's just saying, let's price the insurance more accurately, specifically by location.
And so Wellington's bearing the brunt of that. So we're the highest in the country, is my understanding. Yeah, in terms of insurance costs.
Yeah. And so it just means that, yes, if you're on the edge of a cliff that's eroding, or if you're on the waterfront and could suffer from inundation in the future, then your premiums will change much more differently than if you are just in a relatively safer place with none of those risks. I mean, you can find out those risks too, can't you, by looking at the
talking to some documents. Brokers, I remember a wee while ago, they were sort of talking about how underinsured people are. There's an enormous problem with underinsurance that I'm sure the insurance companies are well aware of, but that people that the replacement cost today of houses would be significantly greater than the average person is insured for.
Right. Yep.
Which is just interesting, right? Like, which must play out in a big, huge disaster would play out quite interestingly to see how that
I guess
all panned out.
Yeah.
I mean, in terms of mitigating insurance costs, I mean, one thing I do is I think to some degree, it's getting to the point where it's so expensive that actually self-insuring to some degree makes sense. And I'm not talking about not having car insurance or house insurance and health insurance, which are all really important, right? But what I mean is, like, if you can get a $5,000 excess, go for that.
So you're self-insuring for the first
$5,000 instead of don't take a $500 excess and pay huge premiums. Just self-insure for a larger amount, take the lower premiums, and go. Really, what you want your house insured for is major disaster that would be life-changing event that if you lost your house.
I mean, obviously it depends on,
and you need to have insurance for your financing.
It depends on your own ability to withstand bumps, to withstand shocks. Like if getting a bill for $500 or $1,000 is really going to cause a huge amount of stress for you, then you want the lower you don't want the lower excess, don't you? But if you can deal with, I mean, I have looked at from time to time I've looked at the options with different excess amounts. And I found that if I increase the excess by, say, $500, I can save $200 or $250 a year, which means I have to claim once every 2 years to make that equation add up, just for example. And I've thought, well, there's no way I'm claiming once average once every other year. So I just increase the
exactly.
Take the savings for sure. Versus
that's a good tip for people, right? Have a look and review it and see whether or not you're paying, the appropriate amount of insurance for that.
Yeah. Now the other thing, of course, was one was the risk-based pricing, much more granular data and so on. The other thing is of course climate impacts, the impacts of climate changes and so on. And we in doing a little bit of research for this, we found some pretty horrific sort of claims in there. There was what was that? What were you telling me before about the risk of insurance premiums in Petone? There
was some research that was done by someone that showed that if a 10 centimetre rise in seawater and sea level happened, that the 1 in 100 year flooding that could happen in Petone would become a 1 in 20 year event.
Yep.
And they surmised that would lead to insurance premiums going from $1,500 to $100,000 a year, which seems dramatic and hard to imagine. But actually, if you think about the logic behind that, 1 in 20 year event to a catastrophic event. I mean, to be honest, people wouldn't even want to live there if that kind of risk. I mean, you're going to get hit with it at some point, aren't you? If you stay there for 20 years. So, so that kind of stuff.
I mean, it does. I would also question our insurance. Is insurance only $1,500 in Petone?
No, I know.
But anyway, the point is that's a massive. That's a scary thought. Yeah. In 20 years, $100,000. I mean, what would they do to the value of a house?
I think that what that really highlights is if climate change continues and is as rapid as all the science is saying it is, which I'm not here to debate that. I don't have any particular bias either way, but certainly generally would follow the science. Then it's really going to change the way people live. It's not just insurance we're talking about here, right? It's going to change the way that things will get insurable, but they'll also get unsellable, right?
That's right.
So the reality is, people will it'll shape urban planning, and it'll really make changes to the way that we're all living over the next 50, 100 years. Yeah. I mean, we may not have to worry about it so much in the next decade, or we may. I don't know, but
I mean, one thing I've noticed is that you get a limb for a property that you're selling or something at the moment, and it shows there's this overland flood escape route or something they call it, where you're on the side of a hill. It's not necessarily a steep hill or whatever, and there's when the water comes down the hill and the valleys and whatever, it has to get down to the flat somewhere, and so it has this channel running across this section or something, and people can be really, really nervous about that. I mean, sometimes I sort of think that people are overdoing it and being unnecessarily nervous about it. Do you have a view on that, or what do you think about that stuff?
I think people generally over
cautious.
Over cautious, and and people tend to make we sort of overestimate these sorts of things in the short term and underestimate them in the long term. I think that's generally how human nature works.
Yep.
But at the same time, you definitely have to consider. I mean, it's a big asset, and it's understandable that people would be nervous about things like that and about that kind of change.
I can imagine that. I mean, I have a bit of that situation at my place. I'm on a sloping site, and there's a one of those flood escape routes or whatever across the front of my site, and so it gets a bit wet there when it's been raining a lot and all that sort of thing. And myself personally, I'm just thinking, okay, well, what should I be doing as a property owner to preserve the value of the property, but also just to make sure that this is not an issue while I'm there. And so I just sort of think, well, I'll spend $5,000 or $10,000 putting a bunch of drainage in to make sure that, you know what I mean?
Well, you get someone to have a look at it, right?
There'll be steps you can take to mitigate this. So this is a lot of this is risk mitigation steps that you can take, right?
Wellington is known for its slips, and we during extreme weather events we have sometimes we've had slips all around the city. So it's not an irrational what concern, and when you've got water runoff like that, I think it makes sense to get someone to have a look at it. I think it's really important. And as you say, mitigate. Just put the steps in place now to make sure it doesn't happen.
It'd be interesting to know if doing something like that would actually alter your insurance premiums, or whether the insurers like to see that sort of thing. I'm sure that if they think the risk is great enough, then that probably does make a difference, or anyway. But.
And so the national, I believe, are looking at capping rates.
Oh, that's right. Yeah, I've heard about this. They're well, it's not national, is it? It's the coalition government, of course. But all these horrific rates increases, and so there is some proposals out there to limit the degree to which councils can actually increase their rates bills. I mean, that sounds like a pretty contentious issue. On the surface of things, you sort of think, well, that sounds like a positive move. We don't want rates to be going up out of control. But what happens if there is this big infrastructure investment opportunity in the city, and it absolutely makes financial sense, and we will get a really good positive, if you could invest $100 million in something and get a return of 10% over the next 50 years on that investment, well, that's going to make ratepayers better off. We will be reaping the rewards of that, and that will actually produce lower rates in the future.
I mean, one positive thing though would be that it would force councils to really look at the budget and really just say no to stuff, rather and strip out stuff to be able to do things like that and help keep them more efficient. But I guess there needs to be perhaps I don't know. I've never researched, never even looked at the proposal, but
maybe there's an ability to say, look, if it's business as usual, you can't increase your rates by more than X. Or more than CPI plus 1%, or more than CPI, or whatever the case might be, inflation. But if it's a new capital investment project, it must meet a hurdle rate of a minimum internal rate of return or a minimum return on your investment of such and such. So they could be separated out, much like in a set of accounts. You separate out, your revenue statement from your assets. That might have been too technical for some, but anyway.
Well, Adam, we've managed to make a podcast on something that we really don't know a lot about. So, hopefully that was useful and interesting, and look forward to doing it again. That was the Lowe Down, and please like and subscribe. We look forward to doing it again, and we'll see you next week.
See you next time.